Hello everyone, and welcome to the Financial Prophet. Today we're going to discuss Mr. Market. It's becoming a bit overbought in the near term. However, more importantly, we will discuss some longer-term catalysts that could push stocks considerably higher by year end. So the tariff jitters, they're back. Mr. Market, the S&P 500, has been overbought for some time now and is potentially getting ahead of itself fundamentally in the near term as well. Sentiment has been uber bullish lately, greedy even. And if there is one thing that we know about sentiment is that it could potentially turn on a dime. Now let's look at this fear and greed index because it gives us an understanding of exactly where we are sentiment-wise in the market. And we see here that the fear and greed index is illustrating extreme greed. So we have a lot of FOMO going on. We have a lot of people, who missed a rally, chasing the rally now. And basically what it's coming down to is that we are becoming overbought technically. We are becoming a little bit maybe overvalued fundamentally in some areas of the market. But perhaps more importantly, the enormous level of greed in the market, the sentiment index is flashing a red light. So let's look at the S&P 500 chart first. So the S&P has appreciated by approximately 30% since its hard bottom in early April. With the RSI pushing over 70 recently, many stocks are technically overbought. Well, granted, we witnessed a golden cross recently, a bullish intermediate and long-term technical indicator. However, we could still witness a pullback or possibly even a correction in the near term. Now let's look at the QQQ ETF. Now, the NASDAQ 100 skyrocketed by a whopping 40% since its ultra-low panic-driven capitulation-style bottom in early April. Now, QQQ and many tech stocks appear technically overbought, which makes them more vulnerable to a potential pullback and even possible corrections in the near term. However, despite the possibility for increased near-term volatility, some pullbacks, and consolidation, this would actually be a highly constructive phenomenon in order to preserve the well-being of the market in the intermediate and longer term. After all, trees don't grow to the sky, and stocks shouldn't go up in a straight line either. 40% is very considerable, especially in such a short time frame of only about 3 months. So I'm not shying away from taking some short-term profits here and hedging more around the highs. And yes, I know we came off an extremely oversold technical level in April, but the market is quite overbought now. Having said that, I remain bullish on high-quality tech, other sectors, and the U.S. economy in general in the intermediate and long term. Yet the tariff impacts and other negative near-term headwinds may affect sentiment, potentially creating some volatility as well as more buying opportunities in the near term as we advance. So while the tariff threat is clearly back, it's not playing nearly as big of an impact on market sentiment as it did early in the year. Apparently, the market is not too concerned with the president imposing 30% tariffs on the EU, Mexico, and other countries. Again, I continue to maintain the position that it is the EU and other countries that may become the net losers if better trade deals aren't reached and the tariff levels aren't reduced. An important element to remember is that the U.S. is by far the most significant importer consumer economy globally. And under these circumstances, the customer will always win in my view. In other words, America is boss in this dynamic. It is in every country's and business's interest to have as much market share as possible in the United States. The 30% tariff cost will likely not be passed on to the U.S. consumer. Instead, most of the cost could be eaten by the foreign companies who will have to reduce costs in order to stay competitive in the U.S. markets. For instance, some U.S. consumers can buy Cadillacs or Lincolns or Teslas instead of buying BMW, Mercedes, Audis, and other cars that are made in the EU. Now, while this is just one very simple example, a similar dynamic applies in many markets and industries. Also, don't forget about America's small business, which is very resilient, and it will be quick to fill any potential gaps left by foreign companies. Now, I say you never bet against America, and in the end, fairer and more balanced trade deals should be achieved. Now, earnings are going to play an exceptionally big role this time around. So we're entering another critical earnings season now, which could be instrumental in determining where companies' earnings may be heading in the next several quarters. We just witnessed companies like JP Morgan, Wells Fargo, Citibank, BlackRock reporting, and they're all beating estimates, and most by a wide margin on the sales, on the EPS side. So we're definitely seeing some very, very stellar results. Banks can set the general tone for earnings season, and I would not be surprised if we continue seeing more sales and earnings per share beats, and we continue to see constructive earnings out of the banks. However, we must watch for rising delinquencies and other debt-related issues as interest rates remain abnormally high in many areas. We also have Netflix, American Express, Charles Schwab, and other significant companies reporting this week. And next week, we have Tesla, MasterCard, and other key companies will also report. Moreover, after this, we will see peak earnings season in late July and early August, with some stocks being essentially priced for perfection. We'd better not see many misses, especially among the crucial bellwether tech firms. Now, if key earnings only come in around the estimates or illustrate questionable guidance, by questionable, I mean just not as stellar as the market expects in some cases, we may see some profit taking, and we could also see some sell the news type events. In a more bearish case scenario, we may witness worse than anticipated earnings and guidance from more companies than usual, which could enable a 5 to 10 correction to transpire in the S&P 500, NASDAQ 100, and other major market indices, ETFs, and stocks in general. And let's just keep in mind that corrections in individual stocks could be much higher, 20 to 30% or more, even if the broader market corrects by just even 5 to 10%. Now, of course, I'm not saying that the earnings are going to come in substantially worse than expected. I actually believe we will have a positive earnings season. But after this kind of rally and, just with the overall dynamic, market participants are looking for excuses to sell in a sort of way. And we could see and we have an increased probability for a correction or a pullback as the market is very technically overbought now. Still, it may be too early to be getting overly bearish, and I believe that most earnings will be fine. Therefore, we may see healthy sector rotation and relatively normal consolidation in many stocks. Yet, some stocks have become considerably more expensive in recent months, and the broader market averages aren't exactly cheap anymore. So let's look at the broader market PE ratios. The S&P 500 now trades around a 25 P ratio. Now that's non-GAAP, which is relatively expensive. The forward PE ratio of about 24 is also not exactly cheap. The NASDAQ 100, we see a similar dynamic, a 32 price to earnings ratio and a 30 forward PE, which is not exactly cheap. However, given all the variables, it's not terribly expensive either. Looking at the Russell 2000, it still seems undervalued with about a 27 forward PE ratio. A lot is going to come down to the earnings. If companies can continue to expand earnings at a healthy pace, then stock valuations and prices can continue to expand in the intermediate and longer term. However, if earnings start coming down due to tariffs, a more significant slowdown, higher inflation, and other variables, we will likely see a transitory period of multiple compression, which will likely lead to lower stock prices in the near term. Therefore, this earnings season is especially crucial in the sense that it could show us where the economy and corporate profits are heading in this atypically uncertain environment in H2 2025 and in early 2026. Now, a good question to ask is, where is the Fed during all this? The probabilities for a rate cut in September have decreased considerably since the market has appreciated substantially, along with inflation rising in recent months, yet we have seen some better than expected inflation readings, like the recent CPI report was lower than expected. I believe that the Fed is overly hawkish relative to inflation and should actually be lowering interest rates now. Moreover, the labor market continues to show resilience, which puts pressure on rate cut probabilities, with only about a 60-40 likelihood for a rate cut versus another hold in September. Yet the Fed is the missing link in all of this. And if the Fed becomes more open to easier monetary policy, like with a new Fed chair, the market would really like that. Also, I believe the market is starting to look past the outdated Chair Powell era, and we could see a more dovish Fed chair appointed next. Nonetheless, the Fed's stubbornness toward providing a more accessible monetary atmosphere may prove problematic in the near term, increasing the probabilities for volatility spikes in future weeks and months, which also increases the probabilities for a pullback or a correction in the coming weeks, actually. So the bottom line is that the positive catalysts, they remain intact. So despite some near-term issues like transitory overbought technical conditions, some fundamental frothiness, uncertainty regarding certain tariffs, and other short-term negative factors, there are plenty of bullish catalysts ahead. AI and other tech-related innovation continues to boom and shows few signs of slowing. Earnings have been solid, even in the previous quarter when things seemed really bad. Even guidance was pretty good then. So I expect to see another solid earnings season. And we could continue to see robust sales and EPS growth. While inflation has increased modestly, it has not been nearly as bad as advertised during the tariff-related panic stage. There are constructive factors in the so-called Big Beautiful Bill, which could unlock economic growth, lower taxes, increase spending, and much, much more. Therefore, despite the possibility for near-term turbulence, I remain bullish on the economy and the stock market in the intermediate and long term especially. Due to this constructive dynamic, I am increasing my year-end S&P 500 price target to 7,000. So that's my profit report. I really appreciate you guys watching it. And more importantly, I hope that the knowledge you gain here helps you make more informed and more profitable decisions in the future. I would also greatly appreciate hearing your comments. So please join the conversation in the comment section below. If you enjoyed my video, please click like, share, and subscribe to my channel. You can also join the Financial Profit, my exclusive investment community, which is Seeking Alpha's #1 service for proven portfolio profits. So don't hesitate to join our amazing investment community now. Thank you very much for watching. See you next time, and have a wonderful day.